Today, we're diving deep into the most recent legal battle involving Roaring Kitty, which occurred in June and July of 2024. This lawsuit is not just another chapter in the ongoing saga, but a significant attempt to silence one of the most influential figures in the retail trading community. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. In June 2024, a new lawsuit was filed against Keith Gill in the United States District Court. The plaintiff, Martin Radoff, a name you might not be familiar with, brought this case forward in what many believe to be an effort to halt the momentum behind the mother of all short squeezes. The aim of this lawsuit appears to be the cessation of Keith Gill's online activities, specifically his influential tweets that have been known to move markets. The accusations in this lawsuit are severe. Gill is accused of market manipulation, commonly referred to as pumping and dumping. The plaintiff's demands are clear. They want Roaring Kitty to forfeit all profits that he allegedly gained through these activities. To put it simply, they are asking Gill to return the hundreds of millions of dollars he reportedly made during the GameStop stock's meteoric rise earlier in 2024. The lawsuit goes into detail, suggesting that Keith Gill was fully aware of the market impact his tweets would have. It alleges that he strategically purchased call options on GameStop before making his return to Twitter, knowing that his large following would cause the stock price to soar. This is where the market manipulation claim stems from, the idea that Roaring Kitty, with his substantial social media influence, could control the stock market. However, this accusation raises an interesting debate. Is there a difference between what Keith Gill did and what financial commentators, such as Jim Cramer, do on mainstream media every day? Both have large followings and the ability to sway stock prices with their opinions. Yet, the focus here seems to be on silencing Roaring Kitty, perhaps because of the unique power he holds as a retail investor rather than a traditional financial professional. One of the more surprising revelations from this lawsuit is that Roaring Kitty, also known as Keith Gill, is a former registered stockbroker. According to the lawsuit, Gill's securities licenses were revoked, effectively ending his career as a stockbroker. This action raises questions about fairness and the extent to which the financial industry is willing to go to maintain control over market narratives. For those unfamiliar with the significance of having a securities license, it is essentially a requirement for anyone who wants to work as a professional in the securities industry. By revoking Gill's license, the authorities have not only stripped him of his job, but also his ability to return to the industry should he ever wish to. This move appears to be a direct response to his activities on social media, where he used his platform to discuss stocks like GameStop openly. The lawsuit highlights a specific event on May 12, 2024, when Roaring Kitty made a highly anticipated return to Twitter. His first tweet after months of silence reportedly led to a significant surge in GameStop's stock price. This event is central to the plaintiff's argument that Gill's actions were not just innocent tweets, but calculated moves to manipulate the market. But what makes this case even more intriguing is the identity of the plaintiff, Martin Radoff. Radoff is not just any individual investor. He is linked to Cornerstone Fund Services, a hedge fund that is believed to have shorted GameStop stock, possibly even using synthetic shares. The timing of the lawsuit, coinciding with the potential liquidation of this hedge fund, suggests that the real motive might be to protect the fund's interests by preventing Roaring Kitty from drawing further attention to GameStop and other heavily shorted stocks like AMC. Adding a layer of intrigue to this story is the discovery that the domain mohs.com, which many might associate with the mother of all short squeezes, now redirects to Roaring Kitty's YouTube channel. This redirection raises questions about who might have purchased the domain and why it now points to Gill's content. Moreover, another domain, september4th.com, also redirects to his YouTube channel. The significance of this date is unclear, but it has sparked speculation among the GameStop community. Some believe it could be related to a pivotal event in the GameStop saga, while others think it might be a clever marketing move by Gill or his supporters. While Roaring Kitty's legal battles dominate the headlines, another significant lawsuit is unfolding between the SEC and Virtu Financial. The SEC has accused Virtu of market manipulation and front-running retail and customer trades. This lawsuit is particularly important because it could reveal the inner workings of how some financial institutions may exploit the market to the detriment of retail investors. Virtu's attempt to dismiss the case was denied by the judge, who stated that the defendants allowed almost unrestricted access to material non-public information and misled their customers. This decision means the case will proceed to court, where more details about Virtu's practices are expected to come to light. The progression of the SEX case against Virtu could have far-reaching consequences, particularly for the ongoing RICO racketeer-influenced and corrupt organizations lawsuit filed by the Department of Justice. The evidence gathered in the SEC case could be pivotal in building a stronger case against major financial players like Griffin and Citadel.
It's worth noting that this series of legal actions seems to be knocking down dominoes one by one.
From the downfall of Andrew Left and Citron Research to the scrutiny on Doug Sifu and Virtu, the path appears to be leading towards some of the most influential figures on Wall Street. Doug Sifu, the CEO of Virtu Financial, has been vocal in his opposition to the SEC's actions. He recently tweeted about his efforts to persuade the SEC to ban exchanges from listing risky penny stocks. Sifu argues that this move would add value by reducing market volatility, but many believe his true motive is to protect hedge funds from the risks associated with shorting these low-priced stocks. Penny stocks are often where synthetic short positions are most heavily concentrated. By delisting these stocks, Sifu could effectively eliminate a significant threat to hedge funds that rely on synthetic shorting to drive down stock prices. If these stocks are delisted, hedge funds would never have to close their short positions, allowing them to continue profiting at the expense of retail investors. AMC, another stock that has been at the center of the retail trading frenzy, also finds itself in the spotlight. Back in 2017, when AMC acquired Carmike Cinemas, the company found itself burdened with $5 billion in debt. At that time, Wall Street analysts gave AMC a price target of $400 per share, despite the debt load. Fast forward to 2024, and AMC is in a much stronger financial position. The company has reduced its debt, increased its revenue, and expanded its number of screens. Yet, the price target for AMC shares has been significantly lowered, likely due to the influence of synthetic shorting and pressure from hedge funds. This situation highlights the power dynamics at play in the stock market. Hedge funds, with their significant resources and influence, can drive down stock prices through synthetic shorting, even when a company's fundamentals have improved. This has led to widespread frustration among retail investors, who believe that the true value of stocks like AMC is being artificially suppressed. Finally, we turn our attention to a hedge fund that was recently penalized for engaging in 10 million short sales without locating shares, a practice that is illegal under Regulation Show. Despite the severity of this violation, the hedge fund was only fined $250,000, a slap on the wrist considering the potential profits involved. This case is yet another example of how synthetic shorting continues to exist in the financial markets, often going undetected for years. It serves as a reminder that while regulatory agencies like the SEC are making progress, there is still much work to be done to uncover and address these practices fully. The story of Roaring Kitty and the legal battles surrounding him is a microcosm of the larger struggle between retail investors and the established financial institutions. As these lawsuits unfold, they not only shed light on the tactics used by both sides, but also raise important questions about fairness, market manipulation, and the role of social media in modern finance. While the outcome of these cases remains uncertain, one thing is clear: the influence of individual investors like Keith Gill is here to stay, and the fight for a fair and transparent market is far from over. As we continue to watch these events unfold, we can only hope that the truth will prevail and that the markets will become a level playing field for all participants, regardless of their size or influence. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.